Sorry. So just to make sure everybody can you hear us in Perth
Yep, all good, thank you.
and Brisbane
Yep, all good.
Sydney?
and Adelaide and Sydney?
We're good.
All right, well, look, what I'd like to do is hand over, first of all, to Elam Kamarakis from Macquarie, who's our host for today in Sydney. So, Elam, over to you.
Thanks, Toby. Good afternoon, everyone. My name's Elam Kamarakis. I head up our Managed Accounts product team here at Macquarie. So on behalf of Macquarie, it's my pleasure to welcome you all to the first IMAP Investment Forum for 2019. Today we have a stellar lineup of speakers in Chris Willaton from Akambo Private and Charles Stodart from Zurich, who will be sharing their insights on what 2019 has in stock for markets and how best to respond to that through managing portfolios. So, have I done something? Whoops. So without much further ado, welcome once again, and I'll pass it back on to Toby so we can get started. Thank you.
Good. Look, thanks very much, Elam. And as Elam said, Charles Stodart from Zurich is going to be talking to us about their views for 2019, and then we'll return to Melbourne for Chris Willaton to talk about how their views on this year are likely to be incorporated into their portfolios. But before I hand over to Charles, just a couple of things about the events that IMAP has planned for 2019. So most importantly, the Advisor Roadshow. This will be the third year in which we've run the Advisor Roadshows. For us, as so many of you have heard me say before, there are sort of four elements to a managed account: advice, technology, investment management, and the sort of legal structures. And the Advisor Roadshow is our opportunity to draw out the way in which advice businesses and licensees can adopt managed accounts in their portfolios. This is especially relevant at a time as we are now in, where in a few days' time the Royal Commission will unveil to us our future. Tomorrow we have the first of our 2019 webinars with Zenith and Perennial talking about active management in microcaps, and from Zenith's point of view, how they incorporate active management into their portfolios. And then in February, treatment of foreign currency, Jonathan Shee will be talking to us about State Street's view on that. And for those of you who are going to the SMSF conference in Melbourne here at the end of next month, IMAP has a managed account central stand, which involves a number of our subscribers. So just a little about the Advisor Roadshow. Some of the topics which we'll be covering is a session on why my business model will survive. Self-licensed, dealer groups, institutional salaried licensees, talking about how they see their business model evolving. A couple of the other topics: how to give advice on managed accounts, Mason Stevens and Praemium, and a compliance manager in each centre, talking about how they give advice on managed accounts. Again, though it will be rapidly written presentations evolved post next Friday. Innovation, Net Wealth running a session on innovation, how they use innovation and the tools they use, how those can be adopted. Best interest duty, a number of lawyers and Hub talking about best interest. So these are the types of topics, as I say, given a particular piquancy by next Friday's events. The awards, for those of you who participated last year, we'll be running the awards again in 2019 across a number of asset classes. Most importantly, the licensee class, won last year by Stamford Brown, and on innovation. And I'm looking forward to that as something through the middle of the year for us. And in August and October, our portfolio management conferences in Sydney on asset allocation, portfolio construction and manager selection, and then in Melbourne in October on the more fine-grained aspects of security selection, international equities and fixed income investing. So without further ado, let me hand over to Charles in Sydney. So Charles can now take care of the slides and look forward to hearing Charles's view on the markets for 2019.
Thank you, Toby. I will, there you are, I have control. So what do markets hold in store for 2019? And it's very kind of IMAP to give us this opportunity to talk through some of the things that we're thinking about and trying to position for in the year ahead. And perhaps I should start off by saying that 2019 for us is likely to be the ebb tide of the economic cycle. Not necessarily its demise, but definitely the ebb tide, and we're starting to see that come through in some of the numbers. I should apologise up front as well. I've got a little bit of the summer flu, so Maggie's assured me that she's ready to step in if things get too tricky. So slowing global growth, benign inflation, and low bond yields will probably characterise the year ahead, but there are clearly some geopolitical factors involved in as well. And some of the broader sort of balance that we've seen over the last few years, we've seen this sort of tussle between macro and fundamental. And really in 2017 and the first half of 2018, fundamentals really took the ascendancy. Corporate earnings really mattered when you're thinking about risk assets. But what we've seen in the last quarter, certainly, is it's been a lot more in balance. And geopolitical concerns have certainly weighed very heavily on the fundamental outlook. So I think it's important just to spend a couple of minutes on 2018. Now, this has been not quite done to death, but maybe by the time I've finished. And then I'll focus on what I see as being 6 important issues that investors need to be thinking about for next year. And really at the outset, my conclusion, if you like, is that risk management has to play a bigger part. So for a long time, it's just been about returns. Going forward, risk management takes becomes far more instructive. Now I have to put this up, which no one can read, and it's really just to say that the outlook is, or any advice I'm giving is not personal, obviously. Really what I'm trying to do here is draw together some of the key thinking from our partners. So we partner up with global equity managers and domestic equity managers, and really I've drawn from their thinking about the year ahead. But it reminds me a little bit of Yogi Berra when he says it's tough to make predictions, especially about the future. So 2018 was grisly at the end. That Q4 really knocked a number of markets into the red. And this is really, this chart, and you don't actually have to see the detail of it, you'll be glad to hear at the back. It's really just, it's a very visual slide. Anything in green is an asset class that has beaten inflation in that calendar year, and it dates back to sort of early 2000s, 2004. The latest chart in red shows that none of these assets outperformed inflation in 2018. So it's a very, very, very difficult year, and we've seen this presented a number of ways. If you look at, this is the worst year for assets. I think 90% underperformed or produced a negative return in 2018. Okay, so we get it. It was a tough year for risk assets. And really, it came to roost in the fourth quarter. Decelerating growth, tighter policy, and political uncertainty really weighed on risk assets. So the S&P posted, for instance, its worst December since 1931. So the really chilling story here, and this is the visual part, is the breadth of the assets. In a more normal year, it's sort of 50-50, and obviously very bullish years like 2017. A lot of assets actually post very decent returns. But this year, everything was in the red. Now, the other conclusion that you might think is, well, that's great. 2019, expect to see a lot more green on the board. And that may well be the case. Certainly 2019 has started very positively for risk assets in general. Very early days, obviously. But that's sort of the sense, is that expectations have been reset to some degree. The other slide that goes hand in hand with this is volatility. And I think volatility is something that we've been able to ignore for a number of years, but it is definitely back on the table. And I really wanted to draw your attention to two things here. One was 2017, which was extremely low volatility. Now, people talk about volatility. What does that actually mean? Well, in 2017, there were only 8 trading days, when the market moved more than 1%. 3% of the trading days had those moves. So incredibly stable, predictable type markets. That is absolutely not the norm. I've only gone back to 2000, but that is the lowest by some measure for a number of years. 2018 was a very different story. So in 2018, we had 64 moves bigger than 1%, or close to about 25% of total. Now, this is actually far more normal. If you're talking a volatile year, 2008, 2009, you're probably talking about 50% moves above 1%. We've just forgotten what that looks like. We've been inured through years of very, very low volatility, but this is an ever-present buddy, if you like, through 2019. This is not going away. And we can think about the low volatility really being a product of very low interest rates, quantitative easing, et cetera, et cetera. This environment, or that environment, has definitely changed. Whether we see it again remains to be seen, but at the moment it is absolutely off the table. Okay, so outlook for 2019, and I do apologize, I will read out some of the numbers here. This is based on IMF forecast, so forecast for 2018 sort of came in at the 3.7% level for global growth, pretty decent. 2019, they actually cut it back to 3.5%. In my mind, that still looks pretty optimistic, given some of the economic data that we're starting to come through at the moment. Looking through at individual countries, you've got the US at 2.5%, EU at 1.6%, China at 6.2%, and Australia I've put in there at 2.8%. Now, the RBA thinks we'll see north of 3%. I don't agree. In fact, one commentator I've read recently thinks Australia might post a 2% number this year. Now, that's a bit extreme, but clearly the move is towards slower growth. So that is the backdrop that we have to be certainly aware of. More broadly, or looking at other factors, inflation is definitely starting to rise in the US. The Fed's becoming less accommodative. I'll go into that in a little bit more detail. But everyone else, I think, is on hold. ECB has recently changed their rhetoric. Bank of England, they try to get ahead of the Brexit curve. They're probably not going to be raising this year unless there's factors out of their hands. BOJ, RBA, thinking pretty much central banks are on hold. And the Aussie dollar is the other favourite in terms of what happens to that. I think it's likely to be highly informed by what happens with US rates. At the moment, the market is expecting the Fed to have essentially stopped. And if that turns out to be optimistic, then we may well see more pressure on the Aussie. Clearly, what happens in China is also important. Okay. I think we're doing questions at the end. I'd normally stop to ask for any questions, but I'll jump straight into the big issues. So first issue, what path will the Fed now take? So this is Jerome Powell. He's been the chair of the Fed for just over a year, and he's overseen 4 rate hikes in 2018. So what can we expect from him? Well, he really much inherited or took on the language from Yellen, which was very much around we'll be data dependent, what we're seeing at the moment supports gradual rises in interest rates, and that was the tone that he took into December, and the market didn't like it at all. What he's since said is that now we're listening carefully. So the market's taken that to mean that the Fed is essentially on hold this year. In fact, if you look at the 1-year rate in the US, it's at 2.59% against a cash rate of essentially 2.5. So there's even only a very small chance of 1 rate hike this year. I think that's probably optimistic. And why I think that's optimistic is that the underlying strength in the US is still apparent. So the Fed has 2 mandates. One is for max employment, and the other is for price stability. And what we've seen is job growth continue quite strongly. Since Trump got elected, there's been over 4 million jobs added in the US, and that continues at a pretty decent pace. So the current rate's about 3.9%, way below where the Fed originally thought was a rate that didn't accelerate inflation, but actually we're starting to see that rate be felt in wage inflation, which is 3.2%. Not a massive number, but the highest since 2009. So this becomes important for the Fed. They can say, look, we're not going to hike because the market doesn't like it, but there could well come a point that that choice is taken out of their hands. So I wouldn't be surprised to see the Fed hike this year, maybe even twice. It's probably not going to do so this quarter, but I think come June, when there's more data on the table, that rhetoric may well have changed. So at the moment, the market's expecting very little. That, I think, may prove a little bit optimistic. What about the rest? This chart is pretty stark. The blue line shows what the Fed's actually done. So there's 9 hikes, but then you look at the scale on the left-hand side and you realize actually that the top bar is only 2.5%. So the scale can be very deceptive. I haven't put the RBA on here, but actually it's probably been, it had a couple of double taps. It's around about the 1.5%. I think the likelihood of the RBA doing anything this year is very slim. And we'll come on to that in a little bit more detail. Some people are actually talking about the RBA actually cutting twice. I think that is an absolute nuclear option for them. They will explore any other opportunity, leaning on the banks to lend more or whatever it might be, macroprudential to save housing, before they'll feel inclined to cut rates again. But it's pretty instructive. Okay, so that's issue one. What path does the Fed take? Issue two is, what is the price of money? So this chart looks at the US 10-year in the sort of bold blue, and the Aussie 10-year in the light blue. And there's a few interesting observations there in my mind. The US 10-year got up to 3.2%, which is really the highest that we've seen for a long, long time in the US, but only briefly, and it's since pulled back to about 2.7. So when you think about that 2.7% versus the cash rate of 2.5, there's not much fat there. And if anything, I think this will be pretty range bound. But clearly it's important. So many risk assets are priced off the risk-free rate of money. So where this goes is going to be incredibly important. The other thing I think that's quite interesting in there is looking at the Aussie rate. Now, clearly we had this transition back in sort of early 2018 when the US 10-year was moved higher. Now, this is an event that a number of market players won't have ever seen, but we've actually seen the US hold up relatively better than the Aussie. The Aussie 10-year is down to about 2.2% now. So it's quite a stark difference, and I think in balance that probably puts pressure on the Aussie dollar. So issue two, what is the price of money? Issue three, I think, is a very interesting one because this is so guided by expectation. This chart looks at the earnings growth by quarter for the S&P 500 in the US. And what we saw in 2018 was just massive earnings growth in corporates, really helped by tax cuts. But even if you strip out the tax cuts, the underlying earnings growth was very, very strong, sort of 12, 15%. So this was a level which was incredibly high. Now what we're seeing is those comps come through, and it's a far tougher environment for corporates. What we've seen so far, and about 20% of the S&P 500 has reported, is actually that it still remains reasonably healthy. Now, there have been a couple of companies that have stumbled, but on balance, about 70% of the companies that have reported so far have beaten expectations. So it's not too bad. And some people think, well, this is better than people feared, but it's actually not too bad. And if that continues, then you'll see earnings growth of about 15% in the US for the fourth quarter. Next year, this year, Q1 onwards, is where it really starts to test the market because the market is going to have to look through some pretty tough comps to even into 2020 to see double-digit growth again. Now, given the pressure that we're seeing on wages, on margins, it's not surprising that we're seeing a number of companies under a little bit of pressure. This was the big saving grace for risk assets when geopolitics first kicked off with Trump, because the fundamental corporate earnings growth was there to pull risk assets through. We're not seeing that at the moment. Now, the one saving grace is that expectations have certainly been reset. So that's what we saw in Q4. The market suddenly realized, Christ, the earnings are going to slow down next year. It shouldn't have been a surprise, but it's like these things take a while. They're there, and finally the market pays attention to it. But then the market can overreact. And the extent of the reaction in Q4 was probably one of the saving grace, i.e. expectations have been completely reset. So issue 4 is on to China. This is obviously relevant not just for Australia, but globally. Chinese growth is slowing, but it is so, even north of 6% is still very, very decent growth for contributing to global growth. In fact, China, I think, contributes about 25 to 30% of the global growth number. So it is significant. Now, where we're at now is actually a bit of a juncture. The leadership in China was looking to tighten some of the financing conditions last year. They may have overdone it a little bit. Now they're thinking about stepping back on the gas. And you've started to see some stimulus measures mentioned, which is why you see this sort of inflection happening throughout 2019. So how successful they are in driving or regenerating some growth in China is going to be very important. The challenge for them is that in the past, they've relied very heavily on debt, on infrastructure projects to kickstart growth again. The opportunity to do that ad nauseam is not there. At some point, projects have to be economic. At some point, debt piles become too high. But China, at the moment, it's disappointing that the trade wars have had some impact. It's quite hard to understand how much. But actually, this slowdown in growth may prompt them to be a little bit more accommodating to some of Trump's demands. But the big kicker will probably be stimulus and how quickly that can be felt in the numbers next year, or this year, sorry. So domestically, what's in store for Australia? We get the Hayne report gets handed down on the 1st of February. It's not clear how quickly we'll be able to see it. The government wants to have a sneak peek before they release it in all its glory, but will number thousands of pages. I think some of the conclusions are have been pretty well telegraphed. It's going to be the detail that probably kicks through. And whereas there were a number of questions posed in the interim, this will be recommendations, so it'll be quite a different beast. What's clear is that banks have modified their lending practices, particularly for housing, and we saw our property manager this morning, and he was just pointing it out. Previously, you could probably get about 12 times your earnings, and banks only really considered your mortgage when they're thinking about the multiple that they're willing to lend. Now they'd consider all your debts, and that multiple's come down to 7. So that is happening. That is being implemented by the banks, and it's certainly being felt in house prices. The picture in the bottom left, and we've seen that. Obviously, I don't need to talk to you in Sydney about that. It's being felt in a number of different capital cities. What is relevant, though, is the bank's expectations for house price falls is probably too optimistic. The bank's forecasting falls of about 10% nationally. Commentators think that probably could be close to 20% by the time it's done. So what are the implications then for the banks? It continues to be a pretty difficult environment, and short of changes in macroprudential policy, it could definitely weigh on things like consumer sentiment, etc. And one of the support of consumption over the last year in Australia, last few years, has been employment growth, which remains pretty decent. Employment rates down to about 5%. So that remains a positive. But for individuals, when you're thinking about what prompts that big ticket item sale, etc., it feels like the confidence isn't there to carry through, and part of that's to do with housing. One interesting stat is that you've seen the saving rate come back from about 12% to about 1% over the last 4 or 5 years. Now, that's understandable when house prices are going up, but when house prices are not going up or even falling, then perhaps people will be more attentive to the appropriate saving rate. And again, that squeezes discretionary spending. So it feels like that 3.25% forecast that the RBA has for Australia feels far too optimistic. 2.8%, maybe a little bit optimistic, and we'll just have to see what the final number is. There is some support. Government construction is obviously very strong in New South Wales, so there is levers that can be pulled. We're not sure what sort of promises are going to be made ahead of the election. That may help to some degree. But then we have, obviously, the implementation to the next half. So I think the first 6 months could be quite difficult from a macro or a GDP point of view in Australia. And then clearly the elections are coming up in May. I think probably a couple of things which will be of most interest is how broad, if Labour is to win, and that the news poll sort of points in that direction, how broad that victory can be. So at the moment, the Senate poses a problem for full implementation of Labour policy, but if the win is big enough, then that may not be a problem. So we have to start thinking more clearly around some of the proposals that they got on the table. So what is the impact of no cash refunds for franking credits? What is the impact of a cut in the capital gains discount? These sorts of things become far more relevant given what we're seeing in the polls. And finally, sixth issue is just geopolitics more broadly. Fortunately, the government is now open in the US after I think it was a record 34 or 35 days, but only for 3 weeks. We'll see what whether they can actually beat out a longer-term deal. That remains to be seen. Trade wars with China. I think what people have underestimated, or what's very, very hard to actually quantify, are the second derivative effects from a trade war. I mean, people are aware that it impacts, but it's very hard to actually put numbers around it. Thank you. I saw one report or one study looked at if a 25% tariff was put on exports globally, so every exporting country had a tariff of 25% put on, then it would only impact global GDP by about 1%, i.e. global growth would go from 3.5 to 2.5, because services are so much more important. Looking at that, you'd think, well, if that's an extreme scenario, we could probably live with that. But what is really hard to quantify is the second derivative effect. So the impact on confidence, the impact on plans to build, where to build, etc. And that seems to be what's starting to come through in some of the reporting numbers that we're seeing at the moment. Brexit. May's got another chance to push through her second plan today. Unlikely to be successful. Who knows what happens in that particular category or in that particular country. You may see dates get moved, pushed out to avoid a no-deal Brexit. But it remains very, very tricky in the UK. And then Trump, he's a wild card. Now that he's lost control of the House of Representatives, his options may be more limited, but that may make him the areas that he can play in include things like trade, foreign policy. So he hasn't gone away as being a factor to contend with. He remains highly relevant and unpredictable, as we know. So with that, those were the 6 issues that I wanted to put on the table. I think sort of the 3 sort of broad points that I wanted to start with is that expectations, or finish with, sorry, is that expectations for risk assets, I think, have been reset to a degree after a pretty optimistic finish into the third quarter last year. Q4 has reset that. I think there are opportunities in equities, but clearly the point is to be selective. And I think in this environment, the importance of an active approach becomes highly relevant. This is where you see broader dispersion in returns. This is where an active manager, a good active manager, can deliver meaningful difference. But above all, I think it's that risk focus that has to be stated. Sorry, I'm just limped through to the end. The risk to bear in mind, though, is that inflation surprise, particularly in the US, and what that means for rates. Trade escalation or a lack of de-escalation is important. Leverage more broadly, and geopolitics remains an omnipresent threat. On a happier note, the Chinese New Year, Year of the Pig, kicks off on the 5th of February. The last year of the pig, and it's a symbol of fortune and luck. So perhaps we shouldn't be too gloomy about this year, but the last year of the pig was 2007, so perhaps it's 2020 that we should be more concerned with. With that, I'll hand back to Melbourne. Thank you very much.
Right. Thank you very much. Charles, are there any questions for Charles before I hand over to Chris? Been an opportunity to ask questions of either presenter at the end of the session. But are there any particular issues which anybody in any of the centres wants to pick up now before I hand over to Chris? No. Well, look. Well, let me introduce Chris Willaton then. Chris is the head of investments for Akambo Private, a well-established Melbourne-based advice business. Chris's background is in private client advice from a number of large investment banks and broking houses. And Chris is responsible for the development of the portfolios that Akambo offers to its client base. So, Chris, without further ado, let me hand over to you.
Great. Thanks, Toby. And thank you, Charles, for that shot of optimism. I won't be controversial and fly in the face of anything Charles is saying. One, because I agree with everything he's saying. And we've been framing a lot of our investment structures and portfolio decisions around the themes and concepts he's been talking about. But also, I want to focus a little bit more today on our journey with managed accounts, which we began 8 years ago. And we've evolved, and our managed account solution has evolved significantly over those past 8 years. But I'm just curious, before I get into that, can I just have a show of hands, in Melbourne at least, I can't see the interstate offices, who has an internally managed account in this audience? It's not too many. Externally managed accounts? Okay, so I can conclude from that not a lot of people are using managed accounts at this point in Melbourne. It must be all in Sydney, WA and Brisbane. All right, well, thanks for having me along today. For those of you who don't know Akambo, we've been around for 12 years. We've been offering the managed account solution. I mentioned before, we started on the journey 8 years ago. It wasn't until 2012 that we started to provide managed accounts. And back then we were providing 5 multi-asset portfolios, each containing our internally managed Aussie portfolio, international and fixed income. And it was interesting because when we started managing the international portfolio, we thought it was just going to be a combination of largely some ETFs and a few large cap notable international companies such as Apple that we thought people would like to own and that would be good investments. And as it's turned out, or as it's evolved, we've been shying away more from ETFs and certainly managed funds and managing most of the investments directly. The background of myself and another one of my partners is in stockbroking, so we've got extensive experience in managing share portfolios. So managed accounts is really an extension of that. As I mentioned, when you're managing $100 million versus 200 versus 500 million versus $1 billion, 2 billion, the solution changes and your managed account solution needs to evolve with that. So as I said, we started with just 3 core portfolios. We've now got 11 single asset portfolios, 10 multi-asset portfolios across a few different platforms. So, the solution continues to evolve based on what clients need and based on the size of the team as well. Going from a team of just 5 in our investment team originally, we're now up to, 2 originally in the investment team, we're now up to 5 internally, but our external network is quite extensive. And being self-licensed, we draw on a lot of our partners, former colleagues, etc., to draw on lots of local and international research from broking houses and investment banks and also various think tanks. At the core of, that must have been your typo, Toby, there, in philosophy. I'm sure it wasn't mine. At the core of the philosophy is a very client-centric approach, and managed accounts really feeds into that client-centric approach. We've always advocated the transparency, and again, coming from a stockbroking background as opposed to, say, a managed fund background, we always like for clients to see that direct approach and also be able to see all the transactions. So that transparency is important. Liquidity is also critical for us, and that's to a degree dictated the composition of our portfolios as well. We won't invest in small cap companies. It's got to be large cap stocks. If we're executing a trade for across a portfolio and it needs to be, say, $10 million in a day, you need to be cognizant of the stocks that you're buying, having that depth of liquidity to ideally have that executed in a day. Again, it comes back to that client experience. You don't want to see 5 contract notes going out over consecutive days to clients because you can't get set on that one position on one day. So we do focus on large cap, liquid companies, and the universe is still quite big for those companies. But also with that, I think when you're giving people transparency in a discretionary environment, then you need to give them some comfort. So you don't want people logging on and seeing their interface and seeing XYZ mining there. You want to give them some comfort around the composition, and for that reason, all our portfolios are primarily household names. So they're large cap, they're liquid, and they're largely household names, which gives clients a lot more of that comfort and peace of mind. And having that transparency also empowers clients and makes them feel more connected with their investments. It enables the advisor to have a better conversation, a warmer conversation with the client, rather than having to explain too much about individual companies. So managed accounts feeds into the solution and the philosophies that we've always embraced for our clients. Again, part of the evolution has been to add various layers of governance to our managed accounts. It's not 8 years ago, Tom Bignell and I sitting around talking about what should be the right approach to manage Akambo's managed portfolios. There's now various layers of governance there. And we, some time ago, well, from the outset, we've had our in-house investment policy. We've beefed up our investment committee to have 2 external members now in our investment committee. So we've gone from 3 to 7 people on our investment committee. So that's been critical in introducing new ideas and also having a more critical assessment of not only the composition of the Akambo portfolios, but the processes we run and the philosophies behind how we run those portfolios for our clients. So that independent insight, whilst painful at times, has been critical to our evolution as a managed account provider. There's also extensive oversight and compliance checks from the platform providers that we use. And we also have independent compliance consulting. And that's quite intensive, but that's important for the managed account process. And obviously over the next week, there's going to be more scrutiny on managed accounts and where they fit into a client solution and a best interest approach for clients too. So we're very comfortable that we're continuing to be ahead of the curve with that. And something we did do a couple of years ago now is adopt Morningstar's asset allocation. Again, as you grow, the solution needs to evolve. And we wanted to have a large international research house that we could pin our name to as the asset allocator for our portfolios. So we use Morningstar as the cornerstone of our asset allocation. But what we do, and the investment committee around the Morningstar parameters then has some various tilts in Australian shares, in international shares, and in growth versus defensive. So and again, the independent components on our investment committee have been critical in having those tilts. So, but as you can see, despite the fact that we do believe, as Charles does, that it's going to be a more challenging outlook for the next 12 months, we think the next few months is going to give us opportunities to cash in on some growth, after which we expect to take a far more defensive tilt in our portfolios. But having the flexibility to tilt around those Morningstar parameters and tilt between Aussie versus international. It's interesting too because one of the things we've moved to or tilted to more prominently in the last few years has been international performance, and that's obviously borne fruit for for a lot of investors. Certainly our clients have seen that with the performance the last few months notwithstanding. The performance of things such as Apple and Amazon and Google, Facebook as well. They've been quite prominent in our portfolios, and it's also a great talking point for the advisors as well to talk about stocks that are very topical with clients. And certainly Facebook and Apple and the returns they've delivered, and the fact that there's something that clients can relate to has been, it's helped the advisor engagement with clients. Must have been you again, Toby. Look, I mean, the investment process, it's a bit messy. The investment process that we've adopted, as I said, we draw extensively from external research, but the systems we've built internally, they're largely driven around managing risk because, the worst 2 or 3 performers in the portfolio is what is going to cost you your performance for the year, and the best 2 or 3 performers in the portfolio over the course of a year, it tends to make or break the overall investment returns. And what we also observe is that the best 2 or 3 months of the year can make or break your returns, and having the ability to tack quite quickly in the managed accounts environment to move defensively, as we did in December in the last quarter of last year, to increase weighting in defensives is certainly quite helpful to overall performance and also for peace of mind for clients. Which brings me to the point of the cash as a barometer, and in constructing a managed portfolio, cash is the first thing that I'll always look at not only to protect the positions in the portfolio, but also provide a war chest for future opportunities. So the cash weighting in our portfolios is really the starting point. And if it's risk on, we'll want to be fully invested. And if there's a lot of volatility and there's potential for further downside, we'll move to as high as 30% cash weighting in each of our portfolios. So the ability to be liquid and mobile with cash has been quite critical for us. That's a starting point. We adopt them thematic exposures. And a key one there has been technology over the past 6 or 7 years, 8 years really, and US-based technology companies, and have done extremely well. The Apples, the Facebooks, Alibaba listed in the US. And then within that theme, we'll then filter down based on a qualitative approach, based on liquidity, what we determine to be the right stocks. You've only got so many bullets to fire in a managed portfolio. It's a high conviction managed portfolios that we run, so we have between 15 and 25 stocks typically. So there's only so many stocks you can have in a particular sector really. And then we have an ethical overlay. I think it's important to believe in something. There's some sectors that will exclude from portfolios. The whole issue of ethical investment is a little bit blurry because my ethics are different from Toby's ethics, for better or for worse. Sorry, Toby, you're becoming the butt of things. But the reality is it's too personal, a completely ethical approach, but we abstain from gambling and tobacco stocks as a starting point and various other investments that we've shied away from. And turnover is something we try to minimise. It's not in our interest to turn over the portfolios. My philosophy has always been that I'd like to buy a portfolio today and never change it. But the reality is that circumstances do change, and you do need to change positions, increase positions, eliminate positions, whatever the case may be. And I've got a slide on turnover in just a moment. This gives you a feel for our portfolios. It's not a live portfolio, but in terms of the weightings and the composition, it's pretty typical. You'll notice down the bottom there that there are a couple of ETFs in the portfolio. We've used beta shares quite extensively over the years, as you plug, Blue. We've got an energy ETF there at the moment. It contains exposures to some large oil companies, Exxon, Chevron, Total, various other global oil companies. Rather than buying one of those singularly, we get a basket of those available through an ETF. And also a robotics ETF that's got exposure to, globally, robotics and automation companies, which is a sector that we think is going to continue to grow over the next several years. And a couple of listed investment companies in there as well, VGI and L1, but it's primarily a direct stock focus within these portfolios. And some of those are cornerstone holdings that have been there for 8 years. Some of them might have been added in the past few weeks. So the duration that we'll hold those for will tend to vary. And we find that we can move weightings up and down between sectors too. I mean, for example, our bank weighting will be, major bank weighting is overweight major banks at the moment. The index has about 20% in the major banks, and we've got 25% in the major banks. There's been times when we've been well above the major bank weighting in the index and times when we've been well below the major bank weighting. But for now, we think that they're cheap, so we're happy to move overweight major banks. And we'll do that by getting an extra parcel of ANZ or an extra parcel of NAB, for example. International portfolio, again, primarily large caps. Stocks you'll be mostly familiar with, and a lot of liquidity there too. And once again, there's a couple of exchange-traded funds in that portfolio too. As you will no doubt notice, it is a US-centric portfolio, and that's where the opportunities have been for the last several years, but that's something we'll be changing more this year. We'll be bringing more, I expect, Asian exposure, potentially some European exposure into that portfolio at the expense of some US exposure. Just to give you an idea of some of the moves that we've made over the past 12 months and the beauty of the proactivity and the transparency in managed accounts, and clients can see what we're doing for them. Through the cycle, we will adjust weightings to various sectors, and early last year, we significantly increased our exposure to resource companies. BHP was a starting point there. We always had an exposure to BHP, but we've increased that weighting to 16% of our portfolio. Technology had been a prominent performer for us and a big exposure for us. In a rising interest rate environment, which is what we saw coming through in the US, we expected that technology shares would suffer. And so up until probably the end of September, we'd reduced our weighting in technology to 28% of the international portfolio. Facebook was 13% in November of 2017, 13% of our international portfolio, and it's, by the end of September it was down to 0. So we progressively cut that. And building materials we cut, and also healthcare stocks we cut significantly, fearing that they would all suffer in a rising interest rate environment. And most of that's proved to be the case. As Charles was saying before, there's been a very benign 2017, saw significant increases in turnover through 2018. As you can see there, we've had reasonable, the average turnover has probably been about 50% in Australia and closer to about 30-35% internationally. And we expect it's going to be around about those levels this year. The year-to-date levels, as you can see there, they've been significantly higher than the whole year of last year, and that's a function of the volatility we've seen in markets. So I've stolen Charles's dot points there because, as I said, I agree with all of those. We're seeing expectations for risk assets being reset, and we've seen that through technology stocks in particular in the US be heavily marked down. And whilst we think at these levels, some of them are reasonably good value, we think that the second half of this year will see them struggle a little bit. Having an active approach is critical. Like the Fed, we are going to be data dependent in our portfolios, but I can see that we're going to take a more defensive skew, certainly in the second half of this year, and probably by the second quarter of this year, I think we'll take a more defensive skew in portfolios. And the one thing that we can be sure of is that there will be more volatility as the investment cycle matures. The depth of any recession we see in the US or Australia is anyone's guess. The sharpest minds in the world can't seem to agree on that. So we can't take a big position on that. Suffice to say that we know things are slowing. We know that the environment's getting more challenging. So we are taking a more defensive tack, and we're prepared to move more aggressively defensively if circumstances require. The other thing that's going to change too is the regulatory landscape. And over the next week, we're going to be hearing a lot more about that. There's been some good papers put out on that can somewhat prepare us, but the reality is, we can only guess what's going to come out over the next week. And certainly it'll have some implications for managed accounts, but like most of us here in the audience, I think we've got a reasonable idea of what's in store, and we can be somewhat prepared, but it's going to be interesting to see what the talking points are next Monday. So on that note, I'd like to throw it open to questions, I believe, Toby.
Yes, thanks very much. Chris, so are there questions from any centre for Charles in Sydney or for Chris in Melbourne here? Yes, if you, I'll repeat the question to make sure everybody can hear. Yes.
Sure. I was just curious about the process that you go through to add an ETF to your portfolio. So you mentioned China and technology, etc.
Yep.
Their process of liquidity, currency, and the underlying.
So the question for Chris is, what process does he go through to add an ETF to the portfolio, liquidity, currency, the other issues?
Yeah, we'll start with a particular thematic view on what sector, region that we think is going to do well. And for the past few years, we've been wanting to get exposure to China, for example. And the view has been that there's more downside in China, and we'll wait till the time's right. And we're also very wary of a lot of the Chinese index. We don't want to get exposure to the Shanghai index per se. So we wanted some sort of actively managed exposure to China. We did look at some managed funds in China, but as I said, my team of 5 sift through what options are available. We looked at several managed funds and ETFs. We've got a lot of people courting us to sell their products to us, and there's a number of notable ETF providers out there. So there was a Van Eck ETF that was called China New, so a free plug for them. And China New had exposure to a number of sectors that weren't necessarily export-oriented. They were more related to internally driven sectors within China. And given China's a dynamic, rapidly growing economy, and with a strong millennial presence there, we figure that stocks that are related to retail and other sectors that will benefit from their changed behaviours will be the ones to invest in rather than exporters and manufacturers. So that's how we filtered through that process. Japan, we wanted a Japanese exposure. We were wary of the currency, but it so happened there was a hedged ETF for Japan. So it'll start with that process we work through. Cash as a barometer for whether it's risk on, risk off, how much risk we should be taking on, then what sectors are appealing and what geographies are appealing, then work down from there.
Stephen, yes.
Just on a similar theme, so it looks like the ETFs occupy their chunks in the portfolios. Just wondering how you choose how to execute it.
So the question from Stephen here in Melbourne is around execution of ETFs for Chris's portfolios.
Yeah. In terms of the physical execution of the trade, we'll have we execute through various large brokers or via the platform, and they'll typically call the ETF provider, make sure there's liquidity, and we'll execute quite quickly and quite seamlessly. So we've never had a problem with that.
Are there questions from Sydney, Brisbane, Adelaide, or Perth?
Yeah, there's a question here in Sydney. You say a question, I'll repeat it.
The question for Chris, being in the advice business and pending the report, final report from the Royal Commission on Monday, but during the Royal Commission sessions, has there been any change to compliance, or has compliance affected you in any way, either in best interest duty or change of portfolio? Because having a background in stockbroking and being able to choose the shares, does it matter to you? Do you have to get consent from clients, or are they all high net worth that give you the authority to change your portfolio?
No, these are all managed discretionary accounts over which we have discretion, and clients have signed off on that discretion. And we meet with our clients, whether it be 3, 6 or 12 monthly, in order to comply with that. And they're aware of how it works. There's transparency. They receive trade advices each time a transaction's executed. So they're comfortable with that discretion. And they know what product that they're signing up for. I didn't hear the first part of the question, but has that answered your question?
Yeah, that's answered the question. And there's one more question here as well, Toby.
Yeah.
Hi, Chris. Just had a quick question around your fee budget. What, I guess, your consideration when looking at your fee budget for your managed account solution?
What do you mean the fee budget?
So I guess the RE costs and so on, what fees did you look at when looking to build your managed account solution? Current fees that your clients were paying. Obviously, there was stockbroking, so they were
Yep.
paying.
We looked at the market. We looked at what the rest of the industry is paying, and we're comfortable that we sit, in the middle.
I guess the question, as I interpreted it, Chris, was probably, do you have a fee budget for the sort of underlying cost to client? The weighted average cost of a conservative portfolio should be 30 points or 40 points, or taking into account ETFs and directs.
No is the answer to that, because it is a bundled service. They're receiving advisory services as well, and the market will dictate the fee. And as I said, we're confident that looking at where our new clients are coming from, and what we see out there in the marketplace, that we're sitting around about the market rate for our fees. So we find that clients are paying anywhere between 0.8 and 2%, and our clients, depending on their needs, which aren't always just asset management needs, they'll sit somewhere in that range.
I've got a question for Charles, which is really as Chris said when he started, Charles, thanks for the optimistic view of the work of this year. So my question really picks up on that, which is the risk of catastrophe. I mean, if we do see rising inflation in the US and globally, if we do see tight labour markets, if we see a couple of Fed rate rises, if we see an Australian dollar fall as a result of the sort of 10-year gap, what could go wrong, Charles, and how bad could it be?
The left tail. It's Toby. I mean, it's a very good question, and I think it's why you might have insurance-style strategies just in play to cover that. I mean, I think to answer that question, you've got to think: is it going to be similar to a catastrophe that we've had previously? So, are you thinking about a GFC-style meltdown, or are you thinking about something more broadly? I think if you're thinking about sort of a financial calamity similar to what we saw in the GFC, I mean, fortunately, the US, which is obviously such an important market, is far better prepared, and they've taken their medicine, and they've come through that process in terms of how leveraged the banks are, or how big the systemic risk is there. But I think that I mean, if you're looking back at what's caused recessions, and I've only got a list of for the US, there have been 18 major recessions over the last century, and they've been caused by 5 different factors. So things like industrial shocks or inventory imbalances. Now, the world has moved on from that. These were things that were far more prevalent at the start of the century. Oil shocks is another one. But if you think about the intensity of oil usage in GDP generation, then certainly in the US that's reduced. Now that remains a risk in countries like China, or where energy policy isn't as advanced, or where there is a reliance on imported oil. But generally I'd say you can discount that to a large degree. Inflation overheating, leading to aggressive rate hikes, absolutely. I think that is, if you're thinking about what could potentially be an outcome this year, that is certainly one. Financial imbalances and asset price crashes, well, that is another factor that remains relevant today. And then fiscal tightening. This is probably not so much an issue. This is thinking about things like post-World War II or post the Korean War, where you have mass demobilizations happening. We're not sort of in that sort of environment. So it's a fairly long-winded answer, but I think that of that list of recession, there's probably 2 factors that are worth keeping an eye on. One is that inflationary risk, and the second is the risk of asset price crash. I'm not neither of those are in our core scenario, but I think that you have to have some insurance to manage those on the possibility that they come to pass. Does that answer your question, Toby?
Yes, look, it does, thank you. And so are there any final questions for Charles or Chris?
Yes, one question from Perth, please. Just interested to hear from either Chris or Charles in relation to emerging markets and their views on those, and perhaps an inclusion of India and its emerging economic power as well.
Yeah, I'll just very quickly say that we've been looking at India for probably about 18 months now. And again, like China, we only added China to the portfolio about 4 to 6 weeks, maybe 6 weeks ago, maybe 2 months ago. It's a reasonably new addition. So we've been waiting for the opportunity to buy that. I think you've got to have a China exposure, and I think you've almost got to have an India exposure. So yeah, we're on the cusp of adding something. It's probably going to be initially about 2.5% of our international portfolio, with a view to increasing both China and India over time. So we have looked at various ways to accommodate that, but I think it's almost something you can't ignore now.
Charles's background is as an Asian equities analyst, so who better to advise you, Chris, than Charles?
So there's probably one thing that you need to be bearing in mind in the short term, and that's the strength of the US dollar, and particularly if the US dollar's strength has probably come back a little bit as people's expectations of rate hikes in the Fed from the Fed have receded, but it does remain relevant for exposure to emerging markets. Valuations in emerging markets are okay. A lot of them got reset in the first half of last year. And I completely agree that if you're thinking about the sort of the demographic dividend from someone like India, then these are countries that you absolutely have to have in a broader exposure to global equities.
Well, look, it's gone 2 o'clock, so please join with me in thanking Chris Willaton here in Melbourne and Charles Stodart in Sydney. Thanks very much. And we thank you for your attendance, and we look forward to seeing you at other IMAP events through 2019. Thanks very much. All right.